So thanks a lot, folks, for joining in. I understand today is Tuesday at 6 p.m. Usually it's time where everybody is going home or it's time for your tea breaks and other things. But still, we wanted to do this session with Shivani because this is very interesting topic because investments in portfolios is important. Of course, in the current market scenario, a lot of things are taking a hit. In this section, in this session, we'll try to help you understand the factors that influence the investment decision to determine the best way to invest your hard-earned money. Before we begin, we want to introduce Nova as well. Nova is an employee wellness platform. Essentially, we help all of your companies ensure that you are super happy, your HRs are happy, and all the teams are happy, right? We also assist organizations in improving the overall well-being through a variety of wellness programs such as daily fitness, annual health check sessions. Apart from this, we conduct these kind of sessions on a regular manner, be it financial wellness, be it kind of physical health, yoga, or food related activities, everything we conduct on a recurring basis. So feel free to join us for other sessions as well. So today we have Ms. Shivani. Shivani is a stock market analyst and a trader, mentor, and an investment portfolio manager. She has trained individuals across India, US, and Canada to become successfully independent traders. I'm assuming everybody like wants to have that kind of money so that we are pretty chill about it. So hence we have her. She's also the youngest female trader to be featured as a speaker at India's most prominent in-house annual trade conference, Traders Carnival. So I think we'll start the session. Just one or two things. If you have any questions, feel free to drop in the chat. My team is looking after that. In the end of the session, we'll have a Q&A wherein we can ask questions and Shivani can choose to answer them or not. Yeah. Over to you, Shivani, now.
Thank you so much, Devansh. That was a lovely intro. And good to see so many people taking interest in this topic. So if we can just move to the next slide, we'll just show what we're going to cover today in brief. And we'll get right started. We're going to cover why we want to invest. We'll understand where to invest and how and why asset allocation is important. And as Devansh rightly mentioned, we'll understand what factors influence investments and how can we manage our risk tools to not let such situations affect our portfolios. And last but not least, how we build the perfect portfolio for you. So before we deep dive into this session, I would like to know from you guys first, are you all ready to achieve financial freedom? If yes, just put a Y in the chat box. Whatever financial freedom means to you, it's absolutely fine. There's no right or wrong answer there. Yeah. I see a lot of Ys in there. Awesome. And if I could just ask you in one line, what does financial freedom mean to you? You can just answer in the chat box. There's no right or wrong answers here. Just want to understand what your point of view of financial freedom is. Then I'll share mine. My money working for me, says I'll say awesome. Peace and self-sufficient, says Hardik. Lovely. Chill Mondays and Tuesdays. Awesome. Understanding the way. Awesome. Buying anything without thinking twice, having more freedom to do whatever you wish. Amazing. Passive income, early retirement. Awesome. Cash on the hand to afford the kind of life we desire. Absolutely. All of this sums up the financial freedom pyramid, as I like to call it. And if I were to just sum it up, what all you have said is that financial freedom is the state or the level where we reach at, where when we waking up the next morning, we're not worried where our next source of income or where the money flow will come from, right? It's not that we stop working or not do anything around or lazy around, but we do what we like. As you rightly said, we make a choice where money is not a question of hiccup or a hindrance. Now, moving to financial freedom and achieving it, there are a lot of talks which go on news and newspapers also, with a lot of formulas and practices given. Now Twitter and telegrams are also good sources, but finance is called personal finance because it's called personal because it's personal for a reason, right? Everyone's why is different. If you can move on to the next slide. Let me just share one story with you. All of us know Adnan Sami, the singer, Lift Kara De Wala, if you remember him. I still remember the first song. It's still my favorite one. Yeah, right. And do you remember how his appearance was when he introduced himself in the industry with the song Lift Kara De, right? He was overweight in an industry where looks are very, very, very important, right? But he was still very successful in getting shows, in getting playback singing and doing albums successfully. He was advised by a lot of his peers and seniors to lose weight, which would be beneficial for him in the industry. But that was not such a motivating factor for him. Why? Because he was already getting work and was successful for most of, in comparison to most of the other peers in his industry. But then came a time where his doctor told him that if you do not lose weight now, it is going to be very serious and it can be a matter of life and death. And that is where we saw Adnan's vibe changing. And then we saw his action plans changing. And I don't need to give you the result. It's in front of you. You have seen him half the size what he used to be and in a much better health. I'm just sharing this example to share it is not what is the best return or what is the best instrument where to invest, but why you want to invest. As you were sharing on the chat box, what financial freedom means to you, why you want to achieve financial freedom, the stronger and clearer the why is for you, easier the how and what to do and how to do will become for you. Are you guys with me till here? If yes, then let's say ready. We will move on to why we want to move towards investments. Awesome. See a lot of readies in the chat box. Now, when we talk about investments, let's just view this, that you are taking a stroll in the park, like leisure stroll in the park. You have AirPods in your ears or earphones, listening to your favorite music and just having a good fun walk, not sprinting or training for marathons, but just chilling around. And then you just see a gym nearby, which has a transparent window. And then you see someone who is racing and running on the treadmill. Now, this imagination is a reality in the sense where we taking a leisure is our income, the leisure work is our income, and the person running on the treadmill is none other than inflation. Moving on to next slide. And now, when we talk about inflation, in front of you, what we have is just a historical graph where you can see the 2022, 24 and 26 projections. But besides that, what you can focus on is how it has moved up and down. Now, what is inflation? What does inflation mean to you? Does it affect your purchasing power? How you see it as your time value of money? Something which you could have bought 100 rupees 10 years back, can you buy it today? Value of money getting reduced, rise in prices of commodities. Exactly, less purchasing power. Absolutely. So what we are seeing right now, anyone knows what's the current inflation rate for our country right now, India? The idea is right in front of you. It's like an open book exam question, but 4.12 would be more of a CPI or food-based number, but yes, around 7% would be much of a fairer number, because when we talk about inflation, the numbers we see on the data, they have a higher weightage to the food prices and all. But in our day-to-day life, we spend a lot more on other avenues also. Something like leisure, our children's education, our travel, etc. And these do not move at 3 to 4%. These move at a much higher rate. Just think of 5 years back, how much a PVR ticket used to cost you and how it costs today, right? So the reason, the baseline why we should move from savings to investment, not just save, but invest, where, as you guys rightly said, you want your money to earn money. You want your money to earn while you sleep also. It will happen only through investments. So the baseline is that we want to invest so that we can beat inflation, right? Are we ready to beat inflation? If we are, we can just put invest in the chat box. Awesome, awesome, awesome. Now, next slide, please. Let us understand where to invest. When we understand why, we need to understand where to invest also. Before I dive into this slide, can I have the first quiz or question for the participants? I would just like to know where you are currently invested in, so we can just understand what's working out. Okay, see a lot of mutual funds, stock markets, gold, silver, fixed deposit, real estate also. Awesome. Okay. Thank you. Mutual funds. Okay, we have, please. If any option which is not there in the question, please do mention. As Hardik has shared crypto, there should be an option of none as well. You can share that here, absolutely. But I really hope after the session that none option changes. Tax saving mutual funds, yes. Tanvi Sachin mentions trading. Awesome. Cool. Thank you so much. I think we have majority people who have been investing in stock market and mutual funds, which exactly, if you see the chart, will show you why, right? As an investor, what are we always looking for? What do you look for in an investment option? What do you decide? Why should I invest in this? What are you looking for? क्या सोच के ये सिलेक्ट करते हैं कि स्टॉक मार्केट में डालूं या म्यूचुअल फंड में डालूं या गोल्ड में या क्रिप्टो में? You can stop sharing the poll if it's over. It's absolutely fine. Returns, more returns, big returns, high returns. It's all about returns, right? Predictability of future returns, lock-in risk in returns. Less risk as well. Absolutely. So if we compare the broad categories, of course, it does not cover the bifurcations also. Now we have a lot of other alternative options also, but these are the broad categories which we invest in. And what I've shown here is the annualized returns of the different categories in the last 2 decades. So if you see equities, now equities are direct equities as well as equity oriented mutual funds, which are at the highest, and real estate right now you can see it at 11.93% because it is at an annualized of the last 2 decades. But if we then see the last 5 to 8 years, then it's been a so-so return. Similarly for gold and FDs also. Now the reason I've shown you this comparison is because there is never an answer of which one of this is the best one. It is all about how you do an allocation amongst all these. Because if you ask your parents a generation back, right? If you tell them, ask them which is the best avenue for investment. If you have asked them, what is the answer you have got? My parents answer FDs and LIC policies. What do your parents say? Gold, FD, right? RD, yeah. And now in this, right now, we have from the last 2 decades, we are moving to more from physical assets to financial assets like stock markets and equity mutual funds and cryptocurrencies also. So what I'm saying here is nobody knows what the future holds. Like we didn't know the war between Russia and Ukraine was going to happen. We had no idea COVID was going to happen and how it's going to affect also. So how do we protect our money? Growing and getting returns, though we look at it as a primary thing to achieve as an investor, the first thing is to protect what we are investing, right? How do we protect that? It is not about choosing the right investment or the best investment where you see the highest returns, but a strategic asset allocation. That means, has simply putting it as not putting all your eggs in one basket, but how you diversify your investments amongst various assets. And how we are going to do it is what we will get into in a few minutes. Before that, we will understand what are the factors which affect the investment's performance. Abhi manlo, you have put in your money in certain investments. What is going to affect how it performed? For example, say property or mutual fund. What will affect the performance? Whether it will get you high returns or not. Government policies, right? News, right? Inflation, right? Market sentiment, right? When it comes to stocks, the management decisions, companies' performances, absolutely. Can we move to the next slide? So there are a lot of factors which affect an investment's performance. What I have drawn down is to the major factors affecting the investment's performance. We'll go from the lowest one to the highest one here. One is the tax rate. Now, how many of us invest first in an insurance or a bond or an ELSS or an equity saving mutual fund to cover the 1,50,000 80CD deduction, which we get by filing our ITRs? If you've done that, put in Y. We get the tax deductions. Then when we have tax different slab rates for different kind of capital gains in different segments. For example, in equities, if we are investing, there are short-term capital gains and long-term capital gains. There is different now for crypto also, though it's unregulated. We saw in the last budget that if you make profit from crypto, you will be taxed. So all these also affect the investment of your performance, because your net return will be considering this also. Economic growth also matter of the country you are in, and the geopolitical surroundings also, what happens. What we're seeing right now in the world scenario, you will see it's not only India which is in trouble, but the trouble is all around, which has partly to do with the Russia scene also, which has a lot to do with the COVID scene also, and a lot of other factors also going in. But these are the kind of things which are sometimes not in our control, but we have to factor in when we are considering the investment's performance. For example, if we talk about, say, what is Saudi Arabia or UAE or Dubai or those states, normally the Gulf states normally known for? Oil, crude oil. That's besides tourism, they are making money out of oil, right? Now, when they had started this a few decades back, Dubai had just 4% of the production what a country named Venezuela had. Venezuela was the highest producing one. But right now, this is what I'm talking about, was in 1962. But if you check right now, where does Dubai stand in terms of power of oil, and where does Venezuela stand, you will see a lot of difference. And that is the difference which is not done by the resources, but the economic growth of the nation. How Dubai grew as a nation state was very different of what Venezuela is at currently is at its current position. So though having more resources, it has not achieved that growth what Dubai and other Arab states could do that. Next, we talk about interest rates. Now, how many of us were updated last week? We saw RBI hiking the rates by 40 basis points. And we saw the market take a tumble in a day, panic all around, bloodbath, Dalal Street. This happened on Thursday. What happens is that in any country where the central bank, pura portfolio red ho gaya, right? When the central bank needs to control the liquidity or the infusion of money in the markets, they increase the interest rate. Let's just dial back 2 years back, okay? When we were stuck in the COVID situation and there was a lot of economic turmoil, we had seen a lot of stimulus packages released by a lot of governments around the world. All this was money infused by the government into the markets. That makes it what? A free flowing money. If money is free flowing in the markets, what does it lead to? A hike in the prices. It leads to more consumption, more demand, hike in the prices, and at the end of the day, inflation, as we all see it right now. So now we are at a position where everything is costly. People are making memes on lemons also, right? I never thought a decade back that we would be talking about inflation and lemons together in the same sentence. But still, we are at that point today. So now we have not only the RBI, but also the Fed and Australia's central bank and Japan's central bank, everyone raising interest rates to curb the inflation. Because 2 years back, giving stimulus was okay, because at that time, it was the necessary thing to do. Why the necessary thing to do? Because at that time, saving lives was more important than economy, right? But right now, we have kind of a situation control with the pandemic, COVID, everything is in much better state. So now we need to control the economy before it goes out of hand. Otherwise, we'll end up in a situation which may be similar to Venezuela or Sri Lanka, where everything is at skyrocketing prices and there is nothing we can do about it. You're all good till now? Awesome. The next we talk about is liquidity. Now, when we are gunning for investments, there are two things what we see when you talk about risk. One is the risk appetite and one is the risk capacity. Now, I have a very good risk appetite. Say, for example, that I'm ready to take a risk in the highest potential reward making investments, which carry the highest risk. But that is my risk appetite. The next question comes, do I have the risk capacity? That means, do I have the liquidity where I can invest? If my income and my expenses are the same, am I left with anything to invest in? No, I don't have liquidity. Or if my expenses are more than my income and I'm in a lot of debt, I don't have liquidity to invest in. So when it is a matter of choice of allocating our money in different investment avenues, liquidity also plays an important role, where we can then do an appropriate allocation or a selection of where to put in our money and how much. Otherwise, it constrains us to invest our money first in just the less risky avenues, even though our risk appetite, may go for the risky avenues as well. So I think risk appetite and liquidity were covered together. And as you can see, the highest major share is about asset allocation. It is not about timing the market. A lot of people we hear saying that market girega tab main kharidunga. When the market falls, I'll buy. When the market goes up, I'll sell. But this is all in the hindsight when you see. Because you never know when the market will bottom, when the market will top. Right now, the market has corrected a lot. At this point, can you tell me that the market cannot go lower than this? It will go higher only. Who's confident about that? Anyone? I am certainly not. I don't know whether the markets will go low from here or high from here, right? Now you tell me, Shivani, what kind of an analyst you are. If you cannot predict, then what are you doing? Let me tell you, let me break this myth. As analysts, our job is not to predict the markets, it's to prepare for the markets. It is all about statistics, probabilities. What we see when we are studying the statistics and numbers is what is the more probable scenario going to happen. But that is not a guarantee. If I say that I see the markets going up from the next month, that is a probability, does not mean that there is a guarantee. And when I do that as an investing or a trading option, I'm also ready for the scenario B, where the situation may go in the other direction. That means the market may go down. So when we talk about being successful as an investor in the markets, along with all the type of investments, especially equity oriented investments, it is not about prediction, it's about preparing. Preparation beats prediction. When you're prepared that if the prices will go up, what will you do? If the prices will go down, what will you do? And if the prices remain stagnant, what will you do? Or even what will you not do is a decision. When you're prepared with an action plan for all of this, you don't need to predict. Agree, disagree? Do you need to, any other scenario is going to happen beyond this? If you talk about, say, Nifty, as we say as a benchmark index, it's either going up or down, or it will remain at the same level. If you have an action plan ready for all three, do you need to predict? No, right? And the fact is that we cannot predict. I'll tell you why. Just imagine your spouse or your parents or someone very close whom you know since more than 2 decades. You know their behavior in and out, you know their quirks in and out. If I tell you that tomorrow 9:15 a.m., tell me how that person is exactly going to behave. Will you able to tell me that? Exactly kaun se mood mein rahenge? Which mood, what will he say, what will he do? No, right? You cannot predict human behavior. And when we talk about, as someone had rightly said in the chat box, market works on sentiments. Be it equity or debt market, all markets work on sentiments because buyers and sellers do at the end of the day make prices. So there's no point predicting markets. So the next time someone tells you they're predicting the markets, run far away from them. Okay, let's move to the next slide. So the question comes, how do we manage the risk? How do we manage? What does risk mean to you? When we think about everything, the possibility of a loss of capital. So we think about everything and then something happens which we couldn't factor in. That is the risk. That means the uncertainty which we are carrying with, right? As you can see on the left, we have the current reality, but it will never be in a linear path, right? It won't ever be a linear growth. There will be a series of ups and lows, ups and downs, highs and lows till we reach our goal. And in between this, what we face is the risk. And how we manage and then control the risk depends upon how we manage our own behavior as an investor. And that will make the difference between what we have the returns as an investor and what returns gets an investment. What I mean by that is, if you see for the last 2 years, Nifty has performed very well before it has corrected from its whole high right now. But since, if you say, take your portfolio, where Nifty was at the highest, was your portfolio also at the highest? Not everyone's will be. And that is the difference between investment and investor's return. And we will move on next to just bridge that gap. Are you ready to bridge that gap? Then just say yeah. Just put a Y in the chat box. Awesome. So now this is a simple tablet, which I feel is going to help you all make the right decision of selecting the right asset for you. So Understanding the broad categories. Now, if I ask you what your financial goal is, you can keep it to yourself, absolutely. Just put it in what approximate amount you wanted and the time horizon you want to achieve it. And then you can choose the asset you want to put your money in. If now, can I have the second question on second quiz on for people? Do you all have emergency fund in place? Do you have an emergency fund in place? Awesome. I'm seeing a lot of yeses also, no's also. And so emergency fund is nothing else than a fund which we do not invest, but a certain amount of money which we keep for like contingent expenses which can arise anytime, say for emergencies like medical or any other. So these funds, you are not expecting to earn out of them, but you want that pool of amount to be there so you don't have to touch your savings when required. So if you don't have that, first have that. Start with an FD, or you can keep it in gold, whatever suits your capacity, and keep it there. So the risk, in the second column, as you see, the risk which the asset carries along with the average returns are annualized is what it carries. And liquidity is like how fast you can convert the asset into cash. Like for example, if it's gold, I can sell it and convert into cash very fast. But if I've invested in a real estate, say for a 2 BHK, which in Mumbai, so a 2 BHK in Mumbai, maybe at current value of say 1 CR, but I need only 50 lakhs. Will I be able to sell half my flat to get the 50 lakhs? That's not possible, right? I either have to sell it all and the entire thing, or just keep it. So that's a low liquidity option. I think, okay. The last thing you can see, the last is the mutual funds, which carry a medium risk. What we will move on in the next slide is how mutual funds work. So as simple as taking money from one person, when we put in direct stocks, we are selecting a stock by ourselves. What we do here is 10 of us and thousands of us put our money in one fund, and that fund manager chooses the securities, that is the stocks or bonds, to invest in. And that combined pool of investment makes and grows and makes returns, and that returns is distributed back to the investors after cutting management expenses. As a lot of you are invested into the mutual funds, I hope your emergency funds are also some liquid mutual funds. Let's move on to the next slide. I'll explain how different mutual funds work. That's why I had categorized it as different than just direct equity, because we have liquid mutual funds also, which are carry low risk and low return, but these can be used for your emergency funds. You can liquidate as fast as 30 minutes also when required. Debt funds are funds which invest in, say, company FDs, bank FDs, and corporate FDs. So it does not carry the equity market risk, but it gives you more returns than your FD and RDs. Balanced or hybrid funds are funds which have a 60-40 ratio, 60% stock markets, 40% debt instruments. So it is kind of a balanced profile where the alpha of the portfolio, the returns is managed by the stock market component and the risk is managed by the debt component. Index funds are funds which follow a particular index. Say for Nifty index is the Nifty 50, or Nifty 500 is the top 500 companies listed on the NSE. And equity funds, as you all may have seen, have different categories. One is tax saving, which are mostly large cap oriented. And then there is a separate large cap oriented fund, as well as mid cap and small cap. These are done by market capitalization, that is the size of the company. And then we have specific mutual funds which choose companies out of specific sectors. So if I say IT, then they are focusing on selecting companies which work in IT, be it software or hardware, be it large cap or mid cap. So as you can see here, higher the risk the fund type of fund carries, higher the potential rewards also they carry. So now let us move on to the last step, which we are all waiting for, is how to build your portfolio. For that, next slide. What we need to keep in mind is that your portfolio is your own and nobody else's. It may sound cliche, but you have to understand that it is to be in your comfort zone. No investment is worth risking your sleep. Your perfect portfolio is your happy portfolio where you can sleep at peace no matter what is happening outside or no matter what your neighbor is doing. Next slide, please. So first, what we'll do is you identify your financial goals. That is the first step, because your goals are different from your friends or neighbors. So don't compare your investments to theirs. Note down your short-term, medium-term, and long-term goals, and then assess your risk capacity. And by risk capacity, I mean, as we had talked before, the surplus which you have, your debt level which you have, compare that along with your appetite of how much of a drawdown in your portfolio you can take. By drawdown, I mean the negative notional returns, that if you invest 100 rupees today and due to adverse scenarios, it goes down to say 80 rupees today, when the market has also gone down by 20%. Would you hold, would you add more, or would you sell it with the fear of more loss? That will define your risk. And remember, there is no right or wrong to this. Assess your risk capacity, which is in your comfort zones, and then align your investments within your goals and risk capacity. So for example, if I want to travel from say Bombay to Pune, what is the mode of transport I can use? What are the options I have? Bombay to Pune, what are the options I can travel with? Rail is one option. Bus is one option. Car, cab, flight, road transport. Yes, amazing. Now, if I want to travel from Bombay to Portugal, what are my options? The destination has changed now. Now we're looking at flight, right? Ship also, right? So depending, the destination is your goal. The mode of transport is the investment you pick, which will be your comfort zone. Like if I pick a flight or a train, the difference will be in costs or the time or other factors. So I can choose whatever suits me. So when it comes to investment also, your goal, your destination, the investment avenue you pick by yourself. Can we have the third question? And the next slide also. So these are the broadly risk profiles what we have. You are either conservative, that means you don't want to take much risk, either moderately conservative, moderately aggressive, or absolutely aggressive. Again, there is no right or wrong. Just identify where you stand at. It will help you to choose your investment vehicle for your financial destination or goal. See, we have a lot of people in moderately aggressive, moderately conservative. The reason we need to differentiate this is what kind of a portfolio may work for a conservative profile may not be suited for a person who is moderately aggressive. So now let's see the next slide, where I'll give you the blueprint or just a reference guide of how to build your portfolio given your risk profile. Are we ready to do that? You want to know which investment vehicles are right for you? Yes. Awesome. So the first one, 1, 2, 3, 4 is nothing else than the risk profiles which we had. So 1 is conservative, 2 is moderately conservative, 3rd is moderately aggressive, and 4th is aggressive. On the left are the short-term goals options what you have, and on the right are the long-term goal options which you have. So if you are a conservative profile, for short-term goals, you can invest in FDs or liquid mutual funds. And for long-term goals, you can invest in gold, which can be physical or in ETF format, and in balanced mutual funds. So as you can see, as we go lower, 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 from 1 to 4, we are taking higher risk options and higher risk avenues. Now, this is something which I would love for you guys to keep a note of, as you have rightly identified your risk profiles. You know your financial goals, or you can plan them out, just jot them down, and then see whether your current portfolio matches your investment profile, or what are the changes what you need to do in that. This is the brief what I have to share with you guys. I hope it has been useful, and I think over to Devansh.
Awesome. I think, Shivani, I was just noting down a lot of points you had. Awesome. Thanks. Folks, we'll start the Q&A. Before that, I think my team would be running a poll, like just to understand how did you like the session and other things. So feel free to add that. And meanwhile, the chat is open. So do ask a lot of questions. Please don't ask. Please avoid crypto questions because I'm not sure it's a very complicated stuff. But
Sure, open to questions.
yeah, Shivani, we have 2 minutes. You can have water break kind of thing.
Oh, thanks.
Folks, any question?
What about
Okay. So there's Marish is asking, what about intraday and option trading? Interesting.
intraday and option trading fit into the highest risk category, and I would suggest that for people who are active in the markets. Like if you understand how the prices work and have the basic knowledge of what we call as technical analysis, then only do it. Don't do blindly on Telegram tips, or just relying on your broker, because those are risky options.
This is interesting. Shivangi is asking, Shivani, do you manage funds individually for people as well?
Yes, I do. That's my job.
Okay. Okay. Shivangi, we'll reach out. We will have that set up for you. Right. So Pratik is thanking you for the session. Sudhi is also
Thank
thanking
you
you for
so
the session.
much. My pleasure.
Ayan Das asks NPS or mutual fund?
NPS or mutual fund, again, it will come down to the question of which kind of mutual fund, and NPS also comes with a lot of tiers. So if you're looking for a retirement kind of option long term, then NPS is more suitable because it comes with a very long lock-in. But if you prefer to have more liquidity, then mutual fund would be better.
Got it. I think Swapnil is asking which factors to check for mutual funds, but for liquid mutual funds, because again, there are a lot of liquid mutual funds in the market.
So liquid mutual funds, it comes with a credit rating. So like how in stock markets, we have the risk of the company not performing up to expectations. The liquid mutual funds carry the credit risk. But when it comes to liquid mutual funds, you can check in any website like Money Control or Value Research, what is the portfolio of the fund, and you can just see the composition, where if it has more government securities and AAA rated securities, then that is the one you should go with. And in selecting the fund, like if you want to choose which you want to invest in, HDFC, Axis or someone, then see the size of AUM that fund is managing. So your downside is protected.
Interesting. I think Shubham has a very interesting question. I think a lot of us want to ask this as well. So are we in a recession, or are we moving towards a recession? Because it feels like interest rates are hiking and stock markets, all the portfolios in red and everything. So What's
Uh,
what's
yeah.
your let's see.
See, we cannot predict the future. I won't say we are in a recession or we may go in a recession, but you do expect the things to slow down. I'm not expecting returns what we made for the last 3 or 5 years, but yeah, it will slow down. But we cannot exactly say a recession like 2000, 2007, 8 times or 1990 times, because the infrastructure, the financial infrastructure is better, well equipped than that.
Girdhar is asking ETF or mutual funds.
Sorry?
Exchange traded funds or
ETF
mutual
or
funds?
mutual funds. It depends which you want to select on. If you're looking just to follow an index, you can take an ETF, or if you want to invest in gold also, like virtually electronically, not physical gold, then ETFs are better. It's more of passive investing. But if you want active investments, I want to take a little more risk and higher returns, then equity oriented mutual funds or balanced mutual funds would be better.
Got it, got it. Aravind is asking how and when to buy an IPO. I think this is a very interesting topic because when startup IPO comes in, or in general as well, right? So
Yeah.
how
So
do you?
see, the basic, there are two basic reasons a founder or a promoter comes with an IPO. One is to raise funds for expansion, and second is to take an exit. Raise funds and take an exit by selling their stake. So as investors for an IPO ourselves, first we need to know which one of it is. If it's just a stake sell, then there is no value for us at all. Okay. And secondly, when it comes to the valuation of the IPO, we need to understand it, how it compares to the already listed stocks in the index, as well as the company growth prospects. As if we can say, the latest IPO LIC, which was like long awaited and just came after a lot of revisions, valuation wise, it stands better in comparison to the other listed ones, but it is still more of a long-term gain, because the private market insurance players are growing in the market share space when it comes to life insurance.
Got it. Got it. Just as a like, so we would have a lot of these kind of sessions in a continuous manner. Shivani is again doing a session on 12th, I guess. So in case if your colleagues want to join in, please ask them to register via that. Also, we have curated a like very small snip. If you want to show off or show what you learned today, you can use that bit.ly link. I've put it in the chat, so that also goes. Uh, Vijaya asks Shivani, can I know why do you categorize real estate as a high risk? While I agree it's a low on liquidity, I feel it's a safe investment.
That would be very subjective. If we talk about, first of all, when we talk about investment as a real estate, you talk about the investment where you're not currently staying. Okay. Agar aap you've taken a loan to buy your property and you're staying in there, that is not your asset. That's where you're staying at. So when you talk about real estate investment, it's either a second home or your investment in a commercial property or another second property. So the liquidity is the major part why I say it's high risk. And if you see the yields for the past decade, it has not crossed more than 7-8%, even if I talk about rental yields. And if you want to still invest in real estate, I would suggest to look for like smart city options like Dolera, where you can invest in commercial properties and have a lower lock-in period, like 3 to 5 years, and still make decent returns. And it requires a little less starting capital also.
All right. Vamshi is asking, what do you suggest about LIC IPO?
I'll see you on listing. I haven't applied, to be honest.
Okay. Okay.
Given the current market scenarios, and we do study the market premiums also for IPOs before applying, which were not very exciting, to be honest. So if it's a good company, we don't mind picking it up a little higher than the IPO price, which we've done for like, for example, HDFC Life. We kept on buying from 300 to 450 levels, which was absolutely fine, which is much more than the IPO price, even for DMart for that matter. So if it's a good company and doing well, it's like don't keep that FOMO ke IPO mein miss ho gaya, then let go. You can pick it up at decent rates. It's absolutely fine.
Maresh is asking, what about VPF and how to start a VPF?
Sorry, VPF is?
I'm also not very sure what's VPF.
I'm not sure.
Maresh, if you can just post in the chat, we'll pick it up. Shubham is asking, what is NAV in a mutual funds?
So NAV is mutual fund is nothing else than the price of that mutual fund scheme. Just have a stock price, because a mutual fund unit has a lot of securities together. Like if an equity mutual fund is holding like 50 stocks together, it is a weighted average value of that. So it becomes an apple to apple comparison from mutual fund to mutual fund.
Got it. Ayan is asking which list of funds to invest on in all categories. I think it's too broad.
That's a very broad list. That's a very broad list, and I wouldn't answer that, because that would I would need to know much more details about you to guide you effectively here.
I think Manoj is asking why is PPF in the category 2 and not in category 1? I think it's again subjective.
Voluntary provident fund. Okay.
Yeah. Provident fund, yeah.
Yeah, that you can absolutely do, but it depends on your risk profile and how much, what goal you're looking at it for. If you're very aggressive or moderately aggressive profile, then VPF or PPF or even a PF is okay for you. It does not take a very high allocation in your portfolio, but it's good for a fixed income asset allocation.
I think Shivangi is asking, can you suggest a book or source where we can learn more about financial freedom? I'm pretty sure Shivangi got super inspired by today's session.
I think there are lots if you go to see, but
like
you can,
top 1 or 2.
Yeah, top 1 and 2. You can start with if it's like from the absolute beginning levels, you can talk about Let's Talk Money. You can go with that, and then you can check out this book called One Up Wall Street by Peter Lynch. It's one of my favorites because it simplifies the process of picking up investments which can outperform, and it makes it very simple.
Got it.
And the next one is, which is very important, and I think it is getting popular by the day, which is Psychology of Money by Howard Marks.
I think Dushyant is asking separate buying stocks versus mutual funds.
What separates buying stocks?
Like buying stocks separately, or would mutual fund make a lot of sense? But
so if you're like new to the markets, I would suggest you start with mutual funds, so you don't have the burden of choosing stocks by yourself, because mutual fund will give you the option of diversification. Like if you're selecting, say, one stock, if you are buying, say, for example, Maruti, that stock is trading, say, at 6,000 hypothetical level, then first of all, you need 6,000 to buy one stock of Maruti. Similarly, if you are investing in, say, HDFC mutual fund, a fund which holds Maruti at 6,000 but has an NAV of 120. So your 120 one unit also, if you buy, that will cover the growth potential of Maruti also and other 49 stocks also. And if Maruti fails, if you've directly invested in that stock, then you will have a negative return. But here you have a cushion of other 49 companies to cover it. That is what the benefit of mutual fund is over stocks.
Pratik is asking how to invest in REITs, REITs.
REITs are very new in this market. There are certain platforms which you can go online and invest in. Would request first for you to check in the platforms and then invest, because this have certain lock-ins also. But you can definitely, if you are interested in investing in like properties and real estates, and I think REITs would be much of a better option.
I think there was one question. So Shubham is a finance student and want to become an analyst so that with a high-paying job. So any kind of course you would recommend to him?
Unfortunately, we don't have a specific analyst kind of degree or something in India. If you want to become a technical analyst, there are mentors like me available who give courses. You can do that. You can read books like, you can start with books like Rich Dad Poor Dad and get into deep dive with trading for a living. And if you want a degree, there is one internationally accepted and recognized degree. There's only one, which is called CMT, Chartered Market Technician. With this degree, you can get a job as an analyst in any part of the world.
I think there's a last question from Dushyant, and post which we'll close the session. What are the basic things we should check before buying any mutual funds?
I think that's a very nice question, because we usually just look at historical returns while buying a fund, but we have to understand that cycles and sectors keep on changing. So what fund may be the top performing fund in the last 5 years may not be the top performing in the next 5 years. So first of all, you should check the expense ratio, because that will in a way affect your NAV. And please select a mutual fund advisor or a financial advisor who checks in and out of how the portfolios are churning. A mutual fund, any mutual fund is like they have to declare their portfolios every month. That's under regulations. So you can check that on Money Control, Value Research, and such sites. See what they are holding in what allocation and how they are performing in comparison to peers. And if you want to do an historical check, I would suggest do check how a particular fund has performed in comparison to its peers in a bear market. Like see the 2010 times, which are the funds and fund manager especially who have performed better. In a bull market, if you earn 2% less, it won't matter. But in a bear market, if you save 4% in comparison, like if the market falls 20% and your portfolio falls 16%, that means you're doing good. And that is more important. So you can check that. And if you are not very well versed with the technical knowledge of the finances, then do have an expert or a consultant or an advisor doing that for you. It's absolutely fine. The commission will be worth it. It's absolutely fine.
Yeah. Awesome. I think this was great. We can call off the session, and thanks a lot, Shivani, for helping all of us. At least I had taken a lot of notes, and
Thank you.
I noted down all the books as well. But this was super helpful. Thanks a lot, folks, for joining in. And we'll have this repeat session of the same theme on 12th. So if you want your colleagues, or if you want to again join in, feel free to join in at that time as well. Thanks a lot. Bye bye. Take care. Cheers.
Thank you. Bye bye.